Hi, I'm Anthony Parent of IRS Medic, and I want you to do a favor for me. The next time you hear someone say the tax code isn't all that bad, share this video with them, because we're going to demonstrate exactly how incredibly nuts the taxation and reporting of so-called foreign pensions is. In this video, we're going to drill down the most critical aspects of the taxations of these Social Security type benefits and other foreign retirement plans. Now, for those who want more advanced training, good news. Attorney Robert Hansen, Sean O'Connor, and I are going to be offering a much more extensive training for those looking for some CLE or CPE credit with our friends over at Stratford Publishing. We'll be live on Tuesday, January 22nd, 2019, but you'll be able to watch that on replay in case you're a little bit too late. The cost is $177 USD, but we are giving away 3 free passes to enter to win. Simply subscribe to this channel and leave a comment below telling us you want in. On January 18th, 2019, we'll be selecting 3 winners who can attend this training for free. Good luck. Okay, so now let's get into it. If you notice, I use the modifier so-called to describe foreign pensions. Why? Well, the foreign pensions are likely not foreign to you or your client, right? You are living or you're still living in the country in which you have a foreign pension. The reason I think this is a very important distinction to make is that far too many taxpayers or tax professionals assume the worst about themselves or the clients. They feel they can't use the much easier streamlined program or just file missing informational returns like your FBARs, Form 8938, Form 5471, or in the case of foreign pensions, possible Form 3520As and Form 3520s. They judge themselves so harshly and assume no good solutions exist. But don't you see, if a pension is not foreign to you, why would you assume you have a foreign pension filing obligation to the IRS in the first place? Second, you still may be confused about why any of this is taxable. If you live around the world, you know that every other country in practice does not have the universal tax jurisdiction the IRS does. That is, the IRS has the ability to tax you anywhere in the universe. This was all done by a court decision. Now tell me why you think a reasonable person should assume the U.S., the alleged land of the free, has the most aggressive taxing regime the planet has ever seen, all decided by a court case you likely never heard about. By the way, that case was Cook versus Tate, a 1924 Supreme Court case. So now, how do we figure out if your foreign pension is taxable and also if it's reportable? Well, this is how we start our analysis. The first inquiry is whether or not your foreign retirement plan is defined benefit plan or defined contribution. See, with a defined benefit retirement plan, you really don't have an account, do you? You really don't have an account value either, right? So we really shouldn't see any requirements for foreign reporting forms like an 8938 and an FBAR or 3520A or 3520, because there's no numbers to put in. If we're dealing with a defined benefit retirement plan, typically our work is much easier and the consequences for getting something wrong are much less severe. Now, if you have a defined benefit plan, contributions into that plan are usually treated as income. Yet, unlike earned income, this income typically cannot be excluded by the foreign income exclusion. However, foreign tax credits may still be available. So if we don't have a defined benefit plan, it must be a defined contribution plan, right? If so, the next question we ask is, well, who funded most of it? The reason why is the IRS treats pension plans that are over 50% funded by the employee as foreign grantor trusts. The problem with this is that foreign grantor trusts can be very time-consuming and expensive to properly report. A Form 3520A is likely required each year, and the penalty for not filing or filing incorrectly can be $10,000 per form per year. Additionally, there could also be a Form 3520A requirement where penalties can be even steeper. Yet there is an exception that might apply, the 402B exception. The problem is that the default position of the IRS is to reject 402B for everything but some Australian superannuations and Singaporean CPFs. The reasoning is more baffling you could imagine, And we're going to get more into that during our full presentation with Stratford. However, it is possible to get 402B treatment if your plan is something other than an Australian superannuation fund or a Singaporean CPF. And this can save you thousands in tax prep fees alone each year. So now you might be asking, when are you going to be taxed? For grantor trust, you are taxed on the contribution and the growth, but not the distributions. For employee trust, that is everything else, you are taxed on both the contributions and the distributions. That is, in an employee trust, you are allowed to defer taxes. Employer contributions to retirement plans are not excluded by the foreign income exclusion, but they are tax creditable. However, in many jurisdictions, there are no credits to apply. So what questions do you have about the tax treatment of foreign pensions and retirement plans? Please leave them in the comments below. And if you need more detailed training, join us live at Stratford on January 22nd, 2019. There's links to the program below. This is Anthony Parent of Parent LLP IRS Medic, and I thank you for watching.